You didn't lose money last year, but you definitely lost purchasing power. Here is the math nobody tells you. Imagine this. It's January 1st, 2024. You walk into your local coffee shop, you order your usual latte, the barista hands you the cup and you hand over exactly $5. It feels normal. It feels like the same transaction you've done 1,000 times before, but fast forward 1 year. It's January 1st, 2025. You walk back into that same shop. You order the same latte. This time, the price tag says $5.15. You haven't changed your habits. The coffee tastes the same. The barista is the same person, but your $5 buys you less. In fact, it buys you about 93 cents worth of coffee instead of a full cup. Where did that missing 7% go? It didn't go into your pocket. It didn't go into the bank's pocket. It vanished into the air. This is inflation. And if you're keeping your money in a standard savings account, you are actively participating in your own wealth erosion. Welcome back to Fiscal Beacon. I'm your host, and today we are pulling back the curtain on the silent thief of personal finance, dollar inflation. We often hear about inflation in the news, usually accompanied by scary headlines about gas prices or grocery bills. But most people don't understand the mechanical, mathematical way it steals from them over decades. In this video, we are going to break down exactly what inflation is, why keeping cash is a losing strategy, and most importantly, how you can structure your finances to not just survive inflation, but thrive in spite of it. By the end of this video, you will have a clear roadmap to protect your purchasing power. Let's dive in. First, let's get on the same page about what inflation actually is. A lot of people think inflation is just prices going up. While that is true, it's a symptom, not the definition. Inflation is a measure of the decrease in the purchasing power of money. It is the rate at which the general level of prices for goods and services is rising. When prices rise, each unit of currency buys fewer goods and services. Think of it like a leaky bucket. Imagine your wealth is a bucket of water. You work hard to fill that bucket with your income, but if there is a hole in the bottom, the water leaks out over time. Inflation is that hole. The size of the hole varies. The Federal Reserve in the United States generally targets an inflation rate of 2% per year. On the surface, 2% sounds harmless. It sounds manageable. But when you compound that rate over 10, 20, or 30 years, the hole gets significantly larger. Let's look at a real-world example. Say you have $10,000 in cash under your mattress. If inflation runs at 3% annually, in just 10 years, that $10,000 will only have the purchasing power of about $7,441. You haven't spent a dime. You haven't made a bad investment. You simply held onto cash. Yet, you have lost nearly 26% of your wealth's value. This is the invisible tax that nobody sends you a bill for. Now, why does this matter so much? Because we have a psychological bias called money illusion. We focus on the nominal number, the dollar amount we see in our bank accounts, rather than the real value. If your paycheck goes up by 3%, you feel richer. You might even treat yourself to a nicer dinner. But if inflation is also 3%, you are actually no richer than you were before. You have done more work to get the same amount of stuff. This illusion encourages overspending and undersaving, which is a dangerous combination for long-term wealth building. This brings us to the second major concept, the cash trap. Many people, especially those who are risk-averse, believe that keeping money in a high-yield savings account or a certificate of deposit, CD, is the safest place for their money. And technically, it is safe. You won't lose the principal. The bank won't take your money. But as we just discussed, safety has a cost. The cost is inflation. Let's look at the numbers. Suppose you put $50,000 into a high-yield savings account that offers a 4.5% interest rate. Sounds great, right? You're earning money just for letting it sit there. Now, let's say inflation is running at 3.5%. Your nominal return is 4.5%, but your real return, what you actually get to spend, is 1%. Now, let's stretch that out. In 5 years, your $50,000 will grow to roughly $61,300 in nominal terms. That's a gain of $11,300. But if inflation averaged 3.5% over those 5 years, the goods and services that cost $50,000 today will cost about $59,400 in 5 years. So you have gained $11,300, but your baseline for survival has risen by $9,400. You are only $1,900 ahead in real purchasing power. You took on virtually no risk, but you barely broke even. Now, compare that to a scenario where inflation spikes to 6%. In that case, your 4.5% return is actually a negative real return. You are losing purchasing power every single day you leave that money in the bank. This is why safe money can be dangerous in the long run. So, how do we stop the bleeding? We need to understand the difference between nominal returns and real returns. Nominal return is the percentage increase in the dollar amount of your investment. Real return is the nominal return minus inflation. To preserve your wealth, your investments must earn a real return that is positive. Ideally, you want a real return that matches or exceeds the historical average of the stock market, which has been around 7% after inflation over the last century. This is where the concept of asset allocation becomes critical. You cannot beat inflation with cash. You need to own assets that appreciate with or faster than inflation. What are these assets? Historically, broad stock market index funds have been the most reliable hedge against inflation. Why? Because companies can raise prices when inflation hits. If the cost of goods goes up, the company's revenue goes up, and their stock price often follows. By owning a piece of the economy through index funds, you are owning the ability of businesses to pass those costs on to consumers. Let's look at another example. You have $20,000 to invest. Instead of leaving it in a savings account earning 3%, you invest it in a low-cost S&P 500 index fund. Let's assume a conservative average annual return of 8%. In 10 years, that $20,000 becomes roughly $43,000. Now, let's apply that 3% inflation rate. The cost of living has increased, so that $43,000 doesn't feel like double your original money in purchasing power, but it is significantly more than the $27,000 you would have had in savings. You have effectively doubled your real wealth. This is the power of compounding working in your favor, rather than inflation working against you. But stocks aren't the only option. There are other vehicles designed specifically to combat inflation. One is Treasury Inflation-Protected Securities, or TIPS. These are government bonds where the principal value adjusts with inflation. If inflation goes up, the value of your bond goes up. It's a direct hedge. Another option is real estate. Real estate values and rental incomes tend to rise with inflation. If the cost of living increases, landlords can typically raise rents. Commodities like gold or silver are also often cited as inflation hedges, though they can be volatile and don't produce cash flow like stocks or real estate do. The key takeaway is diversification. You don't need to put all your eggs in one basket, but you do need to move them out of the cash basket. Now, I want to be very clear here. I am not a financial advisor, and this is not personalized financial advice. Every individual situation is unique. Your age, your risk tolerance, your debt situation, and your financial goals all play a role in what strategy is right for you. Before making any major investment decisions, consider consulting a qualified financial advisor who can help you build a plan tailored to your specific needs. However, the general principle holds true across the board. Inflation is a certainty. Deflation is rare. Stagnation is possible. But the long-term trend of fiat currency is downward in value. Therefore, the only way to secure your financial future is to own assets that have intrinsic value or the potential for growth. Let's summarize the actionable steps you can take today. First, audit your cash. Do you have more than 6 months of expenses in easily accessible savings? If so, the excess should be working for you in the market, not sitting idle. Second, automate your investing. Set up automatic contributions to your retirement accounts or brokerage accounts. This removes the emotion and ensures you are consistently buying into the market. Third, focus on your earning power. The best hedge against inflation is often your own skills. Increasing your income through career advancement, side hustles, or education gives you more capital to invest, which accelerates your ability to outpace inflation. Finally, avoid high-interest debt. Credit card debt often comes with interest rates that far exceed inflation. Paying off a 20% credit card bill is mathematically equivalent to earning a guaranteed 20% return on your investment. That is the ultimate inflation hedge. In conclusion, inflation is not just an economic statistic. It is a silent thief that operates in the background of our financial lives. It doesn't break into your house, it just slowly empties your pockets while you sleep. But now that you know it's there, you can stop it. You can choose to be proactive rather than reactive. You can choose to let your money work for you rather than letting it sit still and shrink. Remember, wealth isn't just about how much money you make, it's about how much money you keep and how long that money lasts. By understanding the mechanics of inflation and adjusting your strategy accordingly, you take back control of your financial destiny. You become the beacon of your own financial future, guiding your wealth through the storms of the economy. If you found this breakdown helpful, please hit that like button. It really helps the channel. And if you haven't already, subscribe to Fiscal Beacon. Next week, we are going to tackle a topic that scares many people: the psychology of spending, why you buy things you don't need. We'll break down the behavioral economics behind impulse buys and give you 3 simple tricks to